The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
A record week for the S&P, a phenomenal week for gold, and a stunning about-face for oil. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Boston.
And I'm Scarlett Fu. We're kicking you off to the closing bell here in the U.S. Modest gains in stocks today. We had a burst of trading volume at the open, but it has kind of tapered off since then. You're looking at a gain of 0.5% for the S&P 500. The Mag 7, after the reports out of Netflix, are in focus because big tech is going to start reporting earnings next week, up 0.75% on the day. We had a big repricing in the bond market yesterday for fewer rate cuts. Bonds are back to posting pretty incremental moves here. The 10-year at 4.07%. And you mentioned oil remained down 2% on the day. Demand from China fairly weak at this time when supply is plentiful.
Oil moving lower here on the day. Stocks moving higher. You see that record high on the S&P 500 with the index now on pace to do something hasn't done all year long, and that's logged 6 straight weeks of gains. A 6-week rally that notches yet another record high. And for the day, yes, you can thank big tech, Netflix, Apple, among some of the big movers on the day. And for the week, well, kudos goes to the airline sector and to bank stocks, both set to settle at their highest levels since early 2022. How's that for a broadening of this rally? Meanwhile, Scarlett just mentioned crude oil there. It started the month with its biggest weekly rally in more than a year, and now on pace today for its biggest weekly sell-off in more than a year. A give back of almost all of its gains this month as the geopolitical premium finally fades, shifting the focus back to the outlook, a tepid outlook for an oversupplied market in 2025. But today we're going to focus a little bit on earnings and the health of the consumer. 3 different companies reporting, but 3 very similar messages coming out of the mouths of the executives of each. Ally Financial giving a more pessimistic outlook for auto loan charge-offs. American Express actually seeing a pullback in spending by its younger consumers. And then you have Procter & Gamble, consumer staples, seeing their results dragged down by minimal price increases and a weakness in skincare. Scarlett, I mean, Alex is always talking about investing in your face, but I don't know, apparently they're not getting the message.
Well, you can invest in your face, but you could do it with some discounts along the way, right? So there's corporate earnings, of course, and then there's price action. And this week saw the reemergence of the rotation into small caps, with the Russell 2000 actually outperforming the major indexes. Now, you look at the S&P equal weight index, it's at a record high along with the S&P 500, while the Russell 2000 reached a 2-year high. Now, the difference between their price to sales ratio certainly has been big, but it has narrowed, and it's now near a record low at the moment. So while there certainly is a large discount when you look at the Russell 2000 versus the S&P equal weight index, that valuation gap perhaps is starting to narrow. Romaine?
Yeah, well, who better to talk about the valuation gap with than someone who really has been a pioneer in this space? Rob Arnott is joining us right now to kick us off to the close. He's the founder and chairman at Research Affiliates. And I always feel like value is just such a strange word because it's kind of like a Rorschach test. It can kind of mean whatever you want it to mean. And Rob, you sort of put things, I think, you put the guardrails around it, I think, in a very good way. When you look at that chart that Scarlett just had up and you look at the seeming rotation that we're starting to see into small caps, does that feel like an embrace of value to you?
It feels like a tentative embrace of value. Value is very near its cheapest levels ever. If you look at a blend of price earnings, price to sales, price to dividends, and price to book value, that blend of measures saw the spread between growth and value at the top of the dot-com bubble rise to an 8-to-1 ratio. At the trough of the COVID meltdown, summer of 2020, it got to a 9-to-1 ratio. During this year, it's been bouncing along very near 8 or 9-to-1 ratio, meaning growth stocks are 8 to 9 times as expensive as value stocks. Now here I'm just using the very simple definition of value that's conventional, and that is stocks trading at deep discount valuation multiples. Some of those are value traps. If you can filter those out, you can do better still. But even if you don't filter those out, in aggregate, value companies are doing fine. Here's a shocker. Since the value rout began in 2007, earnings and dividends for Russell 1000 value have grown almost identically the same as the growth in earnings and dividends for Russell 1000 growth.
That's a pretty phenomenal stat here. But that gets to the question then, when we're looking for value or cheapness or whatever phrase we want to use here, and you're running all those models and doing all those filters, Rob, are you finding a long list of U.S. companies on that list?
Short answer is yes. There's a lot of companies on that list, but the list is longer outside the U.S. Non-U.S. markets in aggregate are priced at about a 1/3 off relative to the U.S., whether measured on price to sales or price to book value or price to earnings or price to dividends. So if you're paying a third less for non-U.S. stocks and paying a deep discount for value both in and outside the U.S., it would seem to us that concentrating on U.S. growth as your core holdings is dangerous exercise in picking up nickels in front of a steamroller.
Okay, no, we definitely don't want to do that. When it comes to small caps, though, the thinking here is that if the Fed is not going to cut rates by as much as people had anticipated, that does not bode well for these companies, many of which are not profitable and really rely on lower borrowing costs to continue to grow their operations.
Well, a lot of them aren't profitable, but a lot of them are. The other thing that's very noteworthy in the markets is one of the most powerful forces at work in the capital markets is mean reversion. That is to say, if you have below average profit margins, you're not going to get new competitors coming on the scene. And the result is you can work your profit margins up. If you have phenomenal profit margins, NVIDIA, take note, if your margins are phenomenal, competitors will be clamoring to try to get into your space. They'll have the effect of reducing your market share and reducing your profit margins. And that's, for the long-term investor, those mean reversion patterns are inevitable and powerful and are often overlooked by many investors.
Yeah, that's a really important point to keep in mind. Rob, I'm curious how you think about the consensus, because when we look at earnings, companies are reporting better than expected results, as they usually do, because the consensus estimate has come down to kind of make it a fairly low bar. And usually the consensus gravitates towards where we want it to. So how do you position yourself for those situations when you're looking for the surprise?
Well, firstly, I love asymmetries and I love volatility. If you don't want volatility in the markets, then stick your money in the bank. If you value the opportunities that are presented by volatility, then when something tumbles and its fundamentals don't, you may have a bargain. If something soars and its fundamentals don't, you may have a stock that's gotten ahead of itself. Volatility is our friend if we use it correctly. I mentioned asymmetric risks. We love asymmetric risks as well. When you're talking about Fed policy, for instance, Fed policy does have a bearing on growth versus value. Lower interest rates do help growth stocks because the discount rate that you apply to that long-term future growth is lower, so the value of that growth is higher. But there's a more powerful link with inflation. Inflation has indeed moderated. There's an asymmetric risk. The consensus expectations for the coming 10 years are 2.3% inflation. If I ask 100 people, do you think 1.3 or 3.3 is more likely? 95 of them will say 3.3 is more likely. And if you have an asymmetric risk, that gives you additional opportunities. Inflation, rising inflation, is good for value stocks and good for small cap stocks. Why? Because rising inflation goes hand in hand with rising economic uncertainty and rising volatility. The rising volatility means that investors want to take a flight to safety, take a step back to safer stocks. Well, that tends to mean value stocks, having a decent base of earnings and dividends in your portfolio. And you get that with value, you get that with small cap, and you get that with non-US.
All right, always an education anytime we talk to you, Rob, and always appreciate your time. Rob Arnott, he's the founder and chairman of Research Affiliates, kicking us off to the close as we focus in on some of the big earnings that we've gotten over the past 24 hours, and that includes Netflix. Those shares having a phenomenal day after a phenomenal quarter with subscriber growth topping analyst estimates. A breakdown of what it means for the entire streaming sector.
A different earnings story when it comes to CVS, the pharmacy chain ousting its CEO CEO after pre-announcing disappointing results, why the company's new CEO is now telling employees, I need your help.
And we're going to have a conversation with the CEO of the Fearless Fund. They have the latest seven-figure investment here coming off the heels of a lawsuit that threatened to hobble that company's mission. That conversation is so much more coming up in a second, right here on The Close on Bloomberg. All right, let's get a view from the sell side. Our top calls, big movers on the back of analyst recommendations. And we're going to start off today with Albertsons. Wells Fargo actually lifting its rating on the grocery chain to overweight, saying that with the shares down about 17% year to date, there's a, quote, compelling value opportunity for investors. And while the proposed merger with Kroger is still in regulatory limbo, the analyst is confident of a, quote, solid plan B. Those shares up about 3% on the day. Coherent is up next. B. Riley downgrading to neutral its recommendation on the company, which primarily makes lasers and other optical equipment for chip making and other types of high-tech manufacturing. Now, while this downgrade is mainly a valuation call, with the shares more than doubling this year, the analyst does raise questions about the company's partnership with NVIDIA on AI transceivers. Those shares down about 3.5% on the day. And let's end things on Netflix. That's got to be the stock of the day here. Most analysts actually maintaining their positive views on the streaming giant after yesterday's solid third quarter report. At least one, though, breaking ranks. That's over at Phillips Securities. Some concerns there about valuation following the recent strength in the shares. The analyst cutting down to neutral from accumulate, though investors, as you can see, clearly not phased at all. 11% bump up on Netflix, up to $764. And those are some of our top calls as we stay on Netflix and turn to an analyst who has, well, a little bit more of a positive outlook on what's going on. We heard from CEO Ted Sarandos last night about growth after that report was released. Take a listen.
We're feeling really good about the business. We had a plan to reaccelerate growth, and we delivered on that plan. And engagement, which we view as our best proxy for member happiness, because when people watch more, they stick around longer. So that's retention.
All right, well, Ted Sarandos confident in those numbers. I think our next guest is also confident in what she saw. Alicia Reese joining us right now, Vice President of Equity Research over at Wedbush. She's keeping her outperform rating on the shares and an $800 price target. All right, Alicia, let's start with the ad tier, because, of course, that's what everyone is focused on right now. And overall, this seems to be a pretty smart move by Netflix. What did you make of it last night?
Indeed. Yeah, they had given us some really great metrics as well. They had just wrapped up a really long upfront season and said that they had, bookings of over 150% larger year over year. And that bodes well for ad revenue in 2025, which is expected to be a big portion of overall growth in 25, but not the biggest portion of growth. That's not supposed to happen until 2026 and beyond, where it becomes the largest portion. So we're still starting from a small base, but we have some really positive metrics coming out of the quarter.
I know they don't want us to focus so much on the subscriber numbers anymore, though I would just presume in advance here that the market is going to obsess over that. You had something interesting in the note that you put out on this idea that ad tier will actually smooth out some of those ups and downs that we had seen in the subscriber numbers over the years. The idea that churn, the dropping off and dropping back in, that might be a thing of the past.
Yeah, I think we really saw that a lot over the past year and a half, almost 2 years now. It's limited churn. It's caused people to think twice before churning out when they don't have the content that they want to see. They're able to check out the ad tier. And more importantly, what we've seen is that new customers have had a chance to come in when they're too price sensitive. Coupling that with the password sharing crackdown that Netflix implemented, that gave people who were kicked off of shared accounts an opportunity to continue watching Netflix at a more reasonable price than they had been offered before. So even when Netflix chooses to increase price, they're doing it selectively. They're doing it on the premium accounts that are not quite as, they're elastic. They're not so concerned about the price, but those low tier ad tiers that they have available in several countries, that price isn't going to change. That's going to be available to a variety of people and get people on the service and limit that churn.
Well, speaking of price sensitivity and price increases, Netflix in the past, and I go back many years now, has increased prices and really drawn a lot of criticism from consumers and subscribers in the way that it did it. What did it learn from that, and how does it contribute to how carefully it now moves when it comes to price hikes?
They were far more surgical this last year with their price hikes. And we saw that because they only raised the price domestically on the top tier, the premium tier, and the basic tier. And the basic tier, the reason they wanted to do that was so that people would opt for the ad-supported tier. It grew the viewership on the ad-supported tier, which they really needed to do to entice advertisers to that service and to keep the CPMs relatively elevated. They were since phased that out. So, they could check out the data, see where it's elastic, and they haven't introduced any new price increases domestically, but they have in other markets. They're phasing out the basic tier in some markets, raising price selectively again. In Europe, they're not doing it broadly because they do get pushback, and they don't need to as much broadly because they have more options for various price sensitivities.
And you had mentioned that the ad tier should become the primary growth driver in 2026. So what will 2025 then look like as it transitions to that point?
I think one thing many investors might be missing is that the subscriber numbers that we saw in the third quarter were decent. They were quite good at 5 million, but they could have been better. And one of the reasons why it was soft and not quite seen in the first half is that the SAG-AFTRA strikes limited the production of content, and the password sharing crackdown really obscured that. The password sharing crackdown is lapping in the third quarter. And so you saw the real effect of that. Yeah. But in the fourth quarter and throughout 2025, that content volume, the content quality comes back in spades. And Netflix has so much cash to spend on the content. And the content is not quite as expensive as it used to be because they don't have the competition for that content that they used to have. So Netflix is really well positioned to put out some excellent content, increase volume throughout all of its regions throughout the next several quarters. And that should increase the subscriber level.
All right, Alicia Reese over at Wedbush, thank you. I know I'm looking forward to Diplomat Season 2 and Squid Game 2 as well. Speaking of these big tech companies, Romain, there was an interesting story today written by our Mark Gurman, who breaks all kinds of news on Apple, that it's lost 2 big people in its HR department just this week alone. Yeah, they lost 2 big people, but I'm more intrigued by where some of those people went. So there's this guy who's not a household name, Short Gehring. Okay. But I kind of did a deep dive on this because basically Ken Griffin, Citadel, hired this guy away from Apple to kind of be a talent recruiter. But I was looking at him, apparently he's like this talent whisperer, like he was at J&J, he was at all these other companies, and really did a great job at bringing in not just mid-level talent, but executive-level talent as well. And when you think about what, of course, Ken Griffin is trying to build with Citadel, I think this is a clear signal here that he has much broader ambitions than just, another, hedge fund product. Absolutely. It also speaks to, on the other end, how maybe there's not as much stability within the HR side of Apple, even as it inspires a lot of loyalty from the ranks of the engineers and the product guys, right? And it's also a maturity thing too, right? I mean, Apple's not going anywhere, but it's like, once it was a young, cool, hip thing. Now it's just, it's your middle-aged dad, wearing New Balances. It's not the growth company it once was. Right, exactly. And you want to go to the new shiny thing. Why not? Citadel. Yeah. All right, coming up, Ally Financial shares are falling after reporting auto borrowing well below expectations. Why the firm is now pulling back to stem souring loans. This is The Close on Bloomberg. All right, shares of Ally Financial and American Express sliding after the pair reported quarterly results that warned of small cracks in the American consumer. Amex trimmed its revenue forecast, while auto lender Ally gave a more bearish outlook for loan charge-offs. Here now to break down the space is Katherine Doherty of Bloomberg News. And Katherine, this is a little bit concerning here because we're talking about discretionary spending when it comes to Amex and also essential spending, which is, your car loans.
That's right. So for Amex, we're talking about the higher end of these consumer spending. So they're starting to see spending is up overall, but what people are spending on, I think they're noting some caution. People are evaluating more so than previous quarters. So that's the skepticism there. With on the other end with Ally, it's really in the lower end of consumer lending. And so they pointed out and have pointed out in recent months the struggles that they're seeing in retail auto book. So today we got some more details on that. That's what the market is reacting to. Overall, the firm has tightened its criteria for who qualifies for an auto loan. So just that skepticism that the company is mentioning, I think, is starting to signal that there could be some more pain ahead.
What can we extrapolate, though, out of some of the broader trends? Because even when the Amex thing, I noticed they talked a lot about on the conference call about the younger consumer. So these are still relatively well-to-do people, but just saying a different mindset in terms of their type of spending. And then with Ally, it's not only just the new originations, but what's on their books right now, and if people are falling behind. So can I add all this up to create a picture of what the overall health of the consumer is, or is this just sort of a niche pocket?
I think what you just described is the spectrum. So you're getting the wider
That's
picture.
A compliment,
yes, because if you want to get the whole picture, right, you got to go from the high end to the low end, and you're going to start to see cracks probably begin at the lower end to begin. But that's why with Amex today, another bit about their earnings is they did have higher marketing spend that I think is what you're reading through on the shares falling today. And they all updated their revenue guidance, which was slightly below what they had originally forecast for the remainder of 2024.
So they had to pay up a little bit more to try to reach their target customer. I know that you cover Bank of America as well. How much of what these two companies said is really echoed or reflected in Bank of America's results?
So Bank of America reported earlier this week, they say they still see consumers in a strong position. Spending is still not quite what we were seeing in 2021, but compared to pre-pandemic, it's up. The rate of spending has come down. That's what they continue to say. We've seen that basically throughout 2024. But really, their charge-offs were not they were higher, but not significant enough that they needed to call them out and basically forecast some negative or cracks that they see to come. But that's a great question. And I guess we'll see if the last quarter of the year there is maybe some of the job growth will also start to come through in some of those results. So it's really just the big question marks that we'll be keeping an eye on.
Yeah. Are you still spending?
I am. Yes, okay. I'm spending on the things travel. I think it's still important to people. Amex called out that overall the flights that are being booked and the hotels, they're still seeing that as a strength.
Yeah.
They're earning on their credit card fees, so people are paying up to get that lounge experience.
Don't get them started. It's a source of good.
Stick around. Katherine Doherty sticking with us for the next 30 minutes. Our thanks to her. We have to say goodbye to her. A closer look here at Ally Financial and American Express and the health of the consumer. When we come back, we're going to take a closer look at the world of venture capital and the Fearless Fund. The CEO, Arian Simone, going to be joining us to talk about the firm's latest investments. That's coming up next, right here on The Close on Bloomberg. Just about 3:30 p.m. here in New York. This is the countdown to The Close. I'm Romaine Bostick.
And I'm Scarlett Fu. And Romaine, it looks like we're going to end the week with gains here for the major indexes, although nothing really to write home about.
Nothing to write home about, but it's kind of just boggles my mind, right? Because we go every week, it's like we get some huge catalyst that everyone gets spooked about the market, and then somehow at the end of the week we still end up at another record high. This is that churn higher, a grind higher, if you will, and I think some people, I guess, are willing to take it, and of course other people are still looking a gift horse in the mouth and wondering when it's all going to end. You're not one of those people, are you?
No, certainly not. It's the path of least resistance to kind of bid the market higher, and that's exactly where we are. But, there's a lot of money still sitting on the sidelines. A lot of people ready to make investments. They're just not quite sure now is the time to go into public markets.
Well, and that's a good point, too. And I was just at an event earlier today, and it was just everyone's is so focused. When you talk about investors and where they're looking, they're not asking me about the public markets. They're asking me about all these companies that are private, all these gigantic unicorns and soon-to-be unicorns, and that's really where they want to put the money. So there's a lot of opportunities out there. Of course, it takes some time and effort, I guess, to find it.
Absolutely. Yeah. Well, let's talk about one of those companies that's in the business of looking for some of those private firms. Fearless Fund is a VC firm that's dedicated to funding businesses founded by women of color. But after a federal appeals court ruled that its grants would discriminate against business owners of other races, Fearless Fund settled the suit and permanently ended that program. Joining us now for more on how the firm is moving forward is Arian Simone. She is founder, partner, and CEO of Fearless Fund. Arian, thank you so much for joining us today.
Thank you for having me.
So I mentioned the lawsuit that's been settled and dismissed. So I'm curious to hear from you. What is different and what's the same about your objective and how you go about fulfilling it now that that suit is in the past?
Understood. Our objective is the same, and it's to bridge the gap of the access to capital that exists and doesn't exist for women of color co-founded businesses. Our thesis at the fund has always been for women of color and funding their businesses, and it still is today.
So your mission remains unchanged, but the suit required you to not necessarily focus on one demographic per se. Tell us a little bit about a recent investment you made, because there was a seven-figure investment in Zimi. Tell us a little bit about the CEO and what it was that attracted Fearless Fund to this company.
I'll definitely get to that. I do want to clarify something, which is the case itself, the program you were talking about was at our foundation. This is an investment, yes, out of our venture capital fund. And we are so excited about Zimi because they are a Y Combinator alum. And people who know in the startup world, a lot of the startups that start off in Y Combinator have gone on to be very successful unicorns. So that's first and foremost. Second, it is solving a problem I'm personally passionate about myself. I actually split my time between America as well as the continent of Africa, and it's solving the problem of logistics and shipping and affordable shipping at that. So you're talking about discounted cross-border logistics being so much less than what they are if you're based in Africa. So just imagine the Amazon of Africa that ships to America. That's what Zimi is doing.
Give us a sense, though, where's the demand for that coming from?
The demand for that is huge. I'll just give you a very elementary example. If I go over right now to Cote d'Ivoire, where I even hold a queenship, and I would like to ship back just boxes and luggages of things, you're talking about a 6-week turnaround, and you're talking about a very, very high fee. They are solving the problem of definitely cross-border shipping at a discounted price. So you're talking 2-day shipping for much, much less than exists in the current market.
I'm sorry, did you say you hold a queenship over there?
Yes, that is true.
Okay, I got to do more research. Well, that's impressive. Congratulations. We'll talk to you about that another day. But on that front, though, when we talk about the opportunities for the fund going forward and these types of opportunities and how you structure them in a way, and I'm just going to put this delicately, where you don't necessarily get the blowback that I think what we saw with the foundation over the last couple of years. How do you approach that? How do you structure that?
Well, how it's currently structured, our thesis is for women of color co-founded businesses. There are other races on their founding teams. They can partner with Black men, they can partner with white men, they can partner with whoever they choose. Our thesis is built on the business case study that diverse teams outperform non-diverse teams, which is proven in any McKinsey report or any other studies that exist. It's just to say that we support the business case study that diversity matters.
Okay, understood. And thank you for the clarification on the foundation versus the fund. When you are investing in Zimi and looking into new opportunities, I know that there was an initial fund, the first fund that closed last summer. Are you investing out of that fund, or is there a new fund that you've launched?
Well, there's Fund 1 and there's Fund 2. So Fund 1 is fully deployed.
Okay.
And that's been deployed for quite some time. Fund 2 is still fundraising. We closed on about $23 million prior to the litigation. And we've had a lot of funds in diligence since then. And now that we're out of litigation, we do plan to continue to fundraise to close that fund. But they are receiving an investment out of our Fund 2.
And of course,
I'm just curious. So on that point, Arian, while you were going through that litigation, did you have trouble raising money during that time? Were people basically on the sidelines?
Of course.
Okay.
So during litigation, we didn't have any closings. We desired to have closings, but we didn't have any closings during litigation. Now that we are out of litigation, we are back in diligence with people and are going to have this closed in a few months.
Understood. Okay. So the second fund, that's a VC fund, so you're acquiring equity down the road. What about a debt fund? I understand that you have started looking into planning a debt fund. What's the demand like for that?
The demand for that is high, especially considering today's macroeconomic climate and the conditions that exist. So right now, we've already launched our debt fund. It's a $200 million debt loan program backed by CDFIs, and they're loans anywhere from $5,000 to $250,000 for small businesses. At the foundation, we offer grants. At the fund, we've always offered cash for equity. And now we have a loan program we can offer that too. So we were just filling in the capital stack. We always desired to have different funding options, and now we just have those.
With regards to the fundraising that you're doing now, is that fundraising, meaning the people who are investing or the companies that are investing, et cetera, is that diverse?
Yes, we've tried to keep pretty much of diversification of our LP base. Primarily, we have had a lot of corporates. We're backed by JP Morgan Chase. We're backed by PayPal Ventures, Costco, Bank of America, Ally Bank, who you all were just mentioning, and a host of others. But we also have individuals that are investors in the fund as well.
Talk a little bit about the big picture here in terms of the disparities in funding. We know that for years, and it continues to be the case, that there are not enough people investing in women of color founded businesses. How has that shifted since the founding of Fearless Fund? Have you seen any meaningful progress there?
We have made a mark, but we're yet to make a dent. Prior to the Fearless Fund existing, especially for Black women being the most founded entrepreneur demographic, the average fundraise was $30,000. Fearless Fund, we came on the scene cutting 7-figure checks. Prior to the Fearless Fund, only 34 Black women in particular had raised $1 million or more for their business. So now that list is past 100. And we are proud to say that we have definitely been a catalyst and influential in getting that done. In addition to that, women of color, Black and brown combined, only receive 0.39% of venture capital funds in its totality. So a lot of work has to be done in this space in order to move the needle, but you're talking trillions of dollars to move the statistics.
All right. Well, you're putting a few million to work right now, of course, with that latest investment in Zimi, and of course, the CEO over there, Audrey Digia. Arian, really appreciate you taking time for us today. Arian Simone, she is the founder and founding partner over at the Fearless Fund. All right, when we come back after the break, we're going to take a look at some of the big movers on the day, and that includes CVS. That stock slipping after a CEO shakeup and reporting in a report where it missed a preliminary profit for the third quarter. That's the stock of the hour, and it's coming up next. This is The Close on Bloomberg. All right, time now for our stock of the hour. A closer look at shares of CVS having their worst day since at least May after reporting preliminary profit results that fell short of expectations. But the bigger news, really, and we have to get right to it here, is the ousting of Karen Lynch. Of course, she had only been on the job for about 3.5 years. David Joyner, the new CEO, taking over and telling employees, quote, "I need your help," looking to fix this troubled healthcare conglomerate. Abigail Doolittle joining us right now. And maybe you can help us out, because when she came in, I mean, that was partly because of the absorption of Aetna. There was this idea that CVS could become this sort of one-stop shop. You go in there to get your toothpaste, you get a flu shot, you get, other medical care. That didn't quite pan out.
No,
so
it did
what's
not.
The strategy now?
Well, I think that we're going to find that out as David Joyce takes the helm with his long experience, but coming from the PBM side, really. I mean, that's where he is right now.
Yeah.
It's interesting. So this news about this CEO replacement is getting the most headlines. In some ways, I would say that's the effect. The cause is what we're talking about right now. The fact that they tried to create this mega mall of healthcare services put together with Aetna, also with Oak Street Health, Caremark, Signify Health, and with the Biden administration clamping down on Medicare, it just sort of fell apart.
But why didn't they move? I mean, we already heard this out of Walgreens. I mean, they had a CEO who lost her job for primarily the same reason. They tried to move down that road, and they just couldn't execute on it.
Well, it's interesting. I think that they thought that, from what I've been reading, a lot of analysts, a lot of investors thought that they were going to say 2025 is the turning point. So I think that they had hope in this old CEO, but it just didn't pan out. And, in terms of that broad strategy, the other effect of that is the pre-announcement we're talking about. But it's not just a pre-announcement. It's 62% on the bottom line. They've suspended the view. 2 years ago, they were talking about $10 per share in adjusted earnings, then $6.50. Now they're saying that doesn't even, cannot be relied on at all. So they're really in a world of hurt. They need a major business model change.
They're asking for patience, but it's hard to get patience when you have activist investors like Glenview Capital in there as well, pushing for perhaps strategic alternatives. What do we know about where that relationship is?
So I think what we're looking at for is some sort of change to be made. It's going to be a negotiation. Perhaps this new CEO, Joyner, is going to have a better relationship with Glenview Capital Management. I think at the end of the day, we've reported in the past that a breakup would make sense. I was looking at GE today. It's almost a $200 stock. I can remember not so long ago when it was a $30 stock. They spun everything out. Maybe something similar here. They try to become big, and maybe now they have to break it back down.
Although I think they also said that that's not a play at the moment. So there's a lot of discussions.
It's sort of similar to Boeing. Maybe this CEO can say something to give everybody relief that for the near term, he can right the ship to some degree and then provide the longer term plan.
Absolutely. Abigail Doolittle with our stock of the hour, which is CVS, one of the big decliners here in the S&P 500. All right, coming up, we're going to count you down to the closing bell with Linda Duessel. She is senior equity strategist with Federated Hermes. This is The Close on Bloomberg.
One of the most powerful forces at work in the capital markets is mean reversion. That is to say, if you have below average profit margins, you're not going to get new competitors coming on the scene. And the result is you can work your profit margins up.
Rob Arnott there, the founder over at Research Affiliates, kicking us off to the close, a discussion there about value, about the asymmetries now in the market that, at least in his mind, actually favors stock pickers like him.
Yeah, but we're not seeing it in terms of the price action, really, because everything kind of just stuck in place. It's another day of sub 1% moves in the S&P 500. In fact, the last time we saw the market close up or down at least 1% was a month ago.
Oh, wow. Yeah. But Scarlett, 5860, that's a record high. You got to be happy about that.
It's a slow melt up.
I guess the question is, what do we want? Do we want sort of like these multiple record highs and sort of these small increments, or do you just want kind of that big, 5%,
There's
rally?
just a sense of everyone kind of waiting for something to happen. There's a lot of event risk coming up. And yes, I know things are moving up, but there is this sense of like, we're just going to hold on for now.
And that was something that Rob talked about a lot about too, this idea that once we get to the other side of this election, you are probably going to see a huge pickup in market activity.
Yeah, it's like everyone has their shopping list and they're just waiting.
Yeah, a lot of people on the sidelines right now for a wide variety of reasons as we move closer to the closing bells here on this Friday afternoon as the S&P sets up for its sixth straight week of gains, a potential record high right now on the board. Linda Duessel joining us right now, senior equity strategist at Federated Hermes. And I do want to start off here with kind of that search for value in a market that, at least in aggregate, doesn't look all that cheap, Linda.
Well, good afternoon, and thank you both for having me back on your show. No, the market's not cheap, and it hasn't been cheap for some while, and and we recognize that, and I think it's now the sixth straight week in a row of gains for the S&P 500. And it's been tough to try and figure the S&P 500 all year anyway, because it's been such a narrow market, and if the big names in the market move, it drags the whole S&P up with it. So what's been great lately, and I think it really is great lately, if we're not having 1% days, if we could just grind forward, which I suppose that's what you would do if you started to move down market cap.
Absolutely, and we've seen people do that. One interesting thing, though, that Rob talked about at the start of this show, as he also moves down to that market cap, he's also moving, or at least looking outside of the U.S. for greater value opportunities. Linda, are you in that camp that that's where you need to go to find better opportunity?
Yeah, it's been a difficult call to do that, as we know, for, 10 or 15 years now. The global economy is slowing down, and the second largest economy, China, is is having, some problems of its own, some stimulus that's been announced, but it doesn't seem like enough stimulus. And if that emerging market can't get on its feet and grow again, it's not great news for the rest of the emerging markets. And then Europe is not doing particularly well itself. It leaves you with America. So here we are with globally banks reducing interest rates. That's into a slowing economy. So you might want to bet on these things in a growing economy that you were sure of.
Yeah, it really feels like this is the new, there is no alternative. You have the U.S. and you don't really want to look at anything else, because if you do, you'll miss out on the gains and the returns in the U.S. One thing that's interesting, Linda, and you point this out as well, is that we've got tight credit spreads, whether it's investment grade or high yield, and you have a fairly high VIX. I know it's down today, but it is higher than for this year's average. What does that signal to you? Is one market wrong and one market right? Is the bond market right and the stock market's wrong?
And that's really interesting. I think it confuses a lot of people because, yes, the market in general is quite strong. And the credit spreads historically were what was the first signal that you were going to have problems in the economy. So it's been very dangerous to call this economy premature, as we know, for the last almost 2 years now. And just here recently, maybe in mid today or yesterday, the Atlanta Fed has raised their growth expectations for the third quarter from 3.2 to 3.4. Growing economy is a bullish thing. The VIX is a funny thing because the VIX, historically, we knew that to be a fear, the fear gauge that we could look at. But if you're having a bunch of movement in volatility because you're churning underneath the surface, then the economy could still actually be doing well. Volatility. Well, let's move from this group to that group. And of course, that's what we've been seeing lately here is the move into potentially a Trump trade and maybe a GOP sweep.
Right. How much active hedging in the stock market are you seeing against event risks, whether it's geopolitics or the U.S. election outcome?
Well, there's no particular hedging at all about geopolitical risks out there. I mean, how could you say that there is when you're at a new record high in the stock market? People have been trying to read the tea leaves here on what is obviously in the end going to be an extremely tight election. And so that's why we're seeing the rotation under the surface where now we can say, you know what, I think maybe Trump is in the lead, and I think maybe there will be, therefore, a GOP sweep, and then maybe, therefore, there'll be just tons of spending and no tax increases next year. And I should go around and look at what is inexpensive relative to the rest of the market or the Mag 7. Mm-hmm. That's just powerful because there's so many stocks that are so inexpensive now.
Yeah,
throw in the earnings of the banks, and that's bullish. It's just bullish.
Yeah, I mean, it was kind of interesting listening to some of the commentary that we got out of the banks, at least the big banks, and they seem to be relatively positive on the economy. I mean, put aside the politics of the election, put that aside for 1 second. If you're just looking at economic data now and you're trying to divine what that trend is going to be heading into 2025 and whether that's going to be supportive of corporate earnings, do you see that support there yourself, Linda, and based on how you view it?
Well, it's all about corporate earnings, and corporate earnings has started out with the bang here, as you know, which is good, and banks are usually a good bellwether for the economy in general. The bifurcation, though, between large cap companies and small cap companies has been very stark, and the small cap business sector sounds like they're really in a bad mood, although maybe in the next 6 months things will get better. You've not seen the decrease in interest rates really help them that much yet. But it's early time. So if I believed, as we do at Federated Hermes, that they're going to cut 4 times next year, inflation is coming down, it's just very hard to be bearish in the face of this, even though we have 6,000 S&P for the end of next year.
All right, Linda, got to leave it there. Linda Duessel, senior equity strategist over at Federated Hermes, counting us down to the closing bells. Just about 3 minutes to go here. Stocks not far off session highs with an S&P up 0.4%. The NASDAQ back in action as well. But we've been talking about small caps all day. The Russell 2000 in the red.
It's in the red, yes, but for the week, it is the best performer, up about 2%. Mm-hmm. So there is that. And that idea that people are moving along to different parts of the market, including the small caps, including the value stocks. Linda Duessel is in Pittsburgh. And so I thought it was interesting that she was attributing this market melt-up that we are seeing to the increasing view that Donald Trump will win the election and the Republicans will sweep both houses of Congress, too.
Yeah, I mean, that's her take.
Yeah.
Well, I guess we're going to find out on November 5th here as we move closer to the closing bells. We should point out that big scare that we had a little bit earlier in the week on the VIX that appears to have abated. You're seeing now yields dropping just ever so slightly here on the day as we move closer to the closing bells.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close, starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostick alongside Scarlet Fu, taking you to the closing bell, a global simulcast. It starts right now. We're joined right now by Carol Massar and Tim Stenovic in the radio booth as we welcome our audience across Bloomberg Television, radio, and our partnership with YouTube here on yet another record day for the S&P 500. Carol Massar, you weren't here yesterday, but the S&P 500 continues to barrel on.
Yeah, or the day before.
Welcome back.
Or the day before.
Yeah.
It's not like I'm not working, guys. You just got to get up
I haven't
early.
seen you in weeks.
All right, whatever. I'm just going to say it has been quite a run for the S&P 500. You know, we've had some guests coming on looking at the market saying they're getting a little concerned about valuation, but we also at the same time have people saying, like, in an election year, it's typically good for equity investors.
Okay, speaking of equity investors, they had a pretty good week, as you mentioned. We had a lot of companies report earnings. The big banks rounded it out. We had Netflix yesterday. I know that's one of your gainers. I'm not going to give it all away, Carol.
Don't take it.
But I'm thinking about next week because we got a ton of earnings on deck. We got Tesla, Boeing, Lockheed Martin, GM, Verizon, IBM, Coca-Cola, AT&T, just to name a few, Scarlett.
Yeah, absolutely. Everyone's got to gear up for that. But you wonder, once we get past that, how much conviction there will really be to take up new positions. I mean, it's all a matter of waiting for all the event risk to go past, right? It's not earnings. We know it's going to be
It's
election.
a single event you're talking about.
Yes. Well, and then the FOMC meeting that comes after that.
Well, I mean, I'll push back on that, though, a little bit, too, because when we talk about this grind higher, and this gets back to the conversation we had with Rob Arnott at the top, the idea that if you are a bottom-up investor here, I mean, this is kind of your time to shine. Yeah, you're not buying baskets of stocks, but there is a lot of value out there. And I think when we talk about that rotation, that's kind of what you're seeing. It's not necessarily a wholesale rotation from sector to sector, but folks trying to find value on an individual stock basis. And at least for right now, the earnings, and for that matter, the economic data is somewhat supportive of that. We do get our record high here on the day on the S&P 500, 58.64 and change, up about 23 points on the day. And that's going to be good enough for about a 0.4% gain on the day as well. The NASDAQ up about 0.6%. The Dow also eking out a modest gain here on the day. And you take a look at the Russell 2000 sitting out the rally on the day, though, as Scarlett was just pointing out here, still a solid weekly gain, a solid outperformance.
All right, guys, taking a look at the S&P 500, you've got a majority of names higher in today's trade. 319 to the upside, 183 to the downside. Number one gainer this week in the S&P 500, Scarlett, United Airlines with about a 20% gain. KLA Corp down about 16%. Worst performer there in that index.
All right, let's take a look at the best performers in terms of sectors on the day. And you can see there's a ton of green there. The only red slice there is energy. Energy stocks down about 1/3 as oil prices get ready to close out a lower week. Communication services, real estate investment trusts, and utilities are the best performers. They're all up at least 0.5%.
All right, guys, to the individual gainers I go as Tim teed me up. Netflix is up about 11%. We're a little punchy on this side. Number one gainer in the S&P 500, also number one gainer in the NASDAQ 100. Guys, you know the story. Stock up 11%, closing at a record. Its best day in a year. Soaring after the streaming company added more than 5 million customers in the third quarter, and it really eclipsed Wall Street's expectations on pretty much every major financial metric. We talked, I know you guys have been talking with our Bloomberg Intelligence, Geetha Ranganathan, just saying it. What an incredible quarter. Really just kind of hitting it out of the park. Also a top gainer in the S&P 500 and NASDAQ 100, Intuitive Surgical. That went up about 10%, and I believe also jumping to a record. Certainly did intraday here. Company reported third quarter adjusted earnings per share that came in ahead of consensus estimates. A lot of Wall Street analysts raising their price target on the company. Piper Sandler said it was encouraged by another strong quarter of placements for the Da Vinci 5. That's that surgical robot that makes it easier for surgeons to kind of understand movement as they are making as they are doing surgery.
Those, you know.
Did you really?
Yeah. I was actually my surgeon was actually one of the pioneers. He actually helped to pioneer that Da Vinci thing when it
cool.
came out. So, but it was I mean, I was asleep, so I don't know how it worked, but I'm here, so I guess
It worked.
Yeah.
Well, and we're glad it worked. We're really glad that it worked.
So.
Yeah. We're glad most days to have you here.
Okay, thank you.
No, I'm just kidding.
Which Punchy days,
I'm
girl.
just kidding. I told you I was punchy. Lamb Weston also among the gainers in the S&P 500, guys. It's up about 10% here at the close. Packaged food company. I mean, who doesn't love potatoes, French fries, or hash browns? I certainly love them. The company coming out, I should say, an activist investor coming out, Jana Partners, saying it built up a 5% stake in the company in a bid to push the French fry supplier to explore strategic alternatives.
What are those alternatives? I was so confused by this. I mean, it's just potatoes. I mean, like, is there some innovation that I'm missing out on?
I don't know. They talk about board composition, management changes.
Operational alternatives.
I mean, I don't know.
Yeah.
You guys need to know this about Carol Massar. She loves French fries.
Whenever Tim and I travel and like we're running to a gate and he's like somewhere grabbing some food and he's like, you want French fries? I'm like, yes, of course, please.
And I get the French fries.
Wait, so let me get this straight. When you travel with her, she's ordering French fries. When she travels with me and I'm paying, she's ordering snails, champagne, and caviar. I'm not making this up.
There's some escargot and some red wine in there.
Okay, interesting.
All right, moving along.
Hey, I do want to get to the decliners today. I want to start with shares of CVS Health Corp. Big news out of the company today. Shares falling more than 5.2%. The company early this morning named David Joyner as its new CEO. It ended a tumultuous tenure for Karen Lynch. The move coming after the company repeatedly missed earnings targets. We saw activist interest setting off unrest among shareholders that came into public view in recent weeks. CVS also, for its part, saying that its third quarter results are expected to miss expectations from Wall Street. The company is going to put its 2024 earnings guidance, pull its 2024 earnings guidance because of those elevated medical costs.
Can I just defend her for a second?
Go ahead.
Because I feel like everyone's kind of putting this on her shoulders. But this is kind of like what the whole industry was doing. This whole, becoming kind of these sort of medical conglomerates, if you will, of turning their drugstores into doctor's office. It didn't work for Walgreens. It didn't work for the competitors. I mean, it was just a bad model, to be honest, or maybe ill-timed is maybe a better phrase.
Even some of the standalone health insurance companies have faced challenges recently. So, look, every model is different.
I got your back, Karen.
Yeah. Okay. All right. Let's go to SLB, the company formerly known as Schlumberger. It's the world's biggest oil field services provider. Shares fell by more than 4.7%. The company came out and warned oil explorers spending growth has waned in recent months. They're taking a cautious approach amid lower crude prices. Scarlett talked about those lower prices. The company also told investors that it expects to exceed its target of $3 billion in shareholder returns this year, as most of its customers' projects are still going ahead. Shares of American Express falling 3.15%. The firm trimmed its full-year revenue forecast. The company predicts revenue for 2024 to increase just about 9%. That prior prediction, Romaine, was between 9 and 11%.
Yeah, absolutely here. And in the way, I think this earnings season is going to really give us a lot more clarity about what's going on and really about the direction of where the Fed goes. And I guess for that matter, where Treasury rates go. And if you look at what happened on a weekly basis in Treasuries, you will see that there's a lot of indecision in this market. On the day, you are looking at yields slightly lower, but at 394 and change on your 2-year and 407 on your 10-year, that's really not much different than where we were a week ago today. And that gets to the whole idea here as to what people really are trying to price into this market.
All right, guys, let's get to some of the stories on our radar. And this is an interesting one, a Bloomberg exclusive. And it gets into the AI services that are being used to detect AI-generated content. Basically, teachers, about 2/3 of teachers report regularly using tools for detecting AI-generated content. And Bloomberg, actually, Business Week, did some research looking into these services, and they found that services falsely flagged about 1% to 2% of the essays as likely written by AI, and in some cases claiming to have near 100% certainty. Sounds like a small percentage, Tim, but you start adding it up and how often they're being used, that could lead to some tough false accusations among the student body.
Yeah, everybody check out this story. It's really interesting because they take you through examples of people who have whose work has been flagged as being generated by AI, but it actually wasn't. And even though it's only 1% to 2% of false positives, the implications of that can be pretty dire when you're in an academic setting.
Yeah, and students who are neurodivergent or students who have English as a second language tend to fall into not this trap, but their work tends to get flagged a lot more than students who are native English speakers and write better, obviously. Another story that we've been keeping an eye on, and this has been at the top of the most read list all day, is how traders at some of the biggest banks have been getting cold calls telling them about jobs at other banks, like at Goldman or at Morgan Stanley, in exchange for some details on their current salaries. And it turns out that these are not real job offers. In fact, these are calls made by an actual recruiting company that's just doing due diligence on salaries.
But this is what sort of, I was so confused by this story because they make it sound like this is a legitimate business practice, but isn't this deception to a certain extent? I mean,
isn't this what?
deception. I mean, I understand you're trying to get information here, but if you're telling people we're recruiting for something that you actually are not recruiting for, and you're just milking them for information, how is that legal?
Well, and they're pretending they're someone else. They're not accurately identifying who they are.
What's going on?
I don't know.
Carol, thanks for showing up today, Carol. You're not giving me any answers today.
I know. Well, I feel like, isn't this what investors do to kind of get information?
Yeah. Yes, and that's called cheating.
Yeah, but they're also misrepresenting themselves by saying, hey, I'm calling about a specific job opportunity.
Yeah, there's no opportunity.
Firm. Right.
Yeah.
I mean, how is that not? I don't know.
Yeah.
I mean, I'm a law and order guy. What can I say?
Yeah, and we're glad you're here. I'm just going to make it set the record straight.
For today, right, Carol?
For today. No, for always. All right, guys, that's a wrap. Our cross-platform coverage.
Memories.
I know. Have a good weekend, you guys.
This is where I just hum the Ave Maria all day.
Oh, boy.
That is a wrap. Our cross-platform, radio, TV, YouTube, Bloomberg Originals. Folks, we will see you again, same place on Monday.
And our coverage continues here on Bloomberg Television. We are looking ahead to some of the big tech earnings up ahead and how it all interplays, of course, with some of what we learned this week out of Netflix. Mark Douglas, Mountain CEO, going to be joining us in just a second. This is Bloomberg.
Welcome back to The Close. I'm Scarlett Fu.
And I'm Romaine Bostick. A sixth straight week of gains for the S&P 500. The NASDAQ getting in on the party as well. Green across the screen on the day and on the week as the rally continues, at least for now, unabated. Not much movement in yields on the week, but you did see some big movements this week in Bitcoin as well as in gold. 2720 and change right now, Scarlett Fu. That's a record high.
Yeah, it's a record high. And it's interesting that you have risk assets and also safe havens moving up at the same time. Is Bitcoin a risk asset or a safe haven? Depends on who you ask. Or neither, according to Romaine Bostick. All right, let's take a look at the big movers on the day. CVS, the worst performer in the S&P after pre-announcing third quarter results would miss estimates, and it withdrew its full year profit outlook because of higher medical costs. Also, there's a big CEO change. The current former CEO, Karen Lynch, is out, and David Joyner, a longtime executive, is her replacement. And of course, maybe this will get Glenview Capital off its back or satisfy some of its demands. Glenview Capital being an activist investor. Speaking of activist investors, Jana Partners is taking a stake in Lamb Weston, the French fry maker, a 5% stake. And so as a result, Lamb Weston, the best performer in the S&P 500. The stock's still down about 27 year to date. Jana says it is undervalued and is looking for an exploration of strategic alternatives.
All right, earnings season is upon us, Scarlett Fu. At least 100 S&P 500 companies scheduled to report next week. That includes names like GM, like Boeing, like Tesla, and UPS. Jess Menton, Bloomberg senior equities reporter, joins us right now. To walk us through here, I think where people's eyeballs are going to be. So let's just pick one, and I assume it's the obvious one. Tesla and Boeing are probably going to be two of the bigger names that I think people are going to be focused on.
And especially with Tesla, because Elon Musk just had that event earlier this month where they were supposed to unveil more details about the robo-taxi that unfortunately disappointed investors because they were looking for more details. And for some context, Tesla's stock, I mean, it was the worst point decliner in the S&P 500 in the first half of the year. Then it rebounded over 30% in the third quarter, but it's had a tough start to now that we're in the final 3 months of the year. So a lot is kind of riding on that as well, because it's been one of those, when you're thinking about the Mag 7 cohort of stocks, it's lagged a lot of the other big tech performances.
6 now.
Right, exactly.
And so this is the first Mag 7 stock to report, right?
So
Tesla,
technically it is, because then the week after that, you'll have Microsoft, you'll have Amazon, of course, Meta, and the other ones. But then NVIDIA isn't until November 20th. It always lags about roughly a month after the rest of them. So they'll have to wait and see that. But actually we have Texas Instruments, if you want to think about chip makers and what they're going to report when it comes to next week. So that'll be important because its revenue growth is expected to contract for an 8th consecutive quarter, but it would be by the slowest amount since 2022.
The whole chip space is such a confusing picture right now, given what we heard from ASML, TSMC, and now Texas Instruments. When you back out the Mag 7, what are we looking at in terms of earnings projections? Because the story up until now has really been about analysts lowering their earnings estimates so that the bar is fairly low.
Yes, exactly. And when everyone wants to talk about the rest of the S&P 500, when we're thinking about the other 493 stocks, and they had really strong earnings growth, around 9% in the second quarter. The thing is, when you're looking at the third quarter specifically, the growth for the rest of the index isn't as strong. It's a little bit under 1% right now, but the reason it's like that is because of energy. So they were cut the most by estimates for the sell-side analysts over the last few months, as well as materials. So it was more in the commodity space because oil prices had lagged in the third quarter. So it wasn't broadly you were seeing earning estimates coming down. It was more energy and materials. So actually, if you're looking at the forward projections for the rest of the S&P 500 at the beginning of next year, they're supposed to be back to double-digit growth and close to be in line with the Mag 7 type stocks. So it's not necessarily a terrible thing that you're seeing that pushback, but it's the energy sector that's really bringing down when you're looking at the rest of the index performance.
All right, Jess Menton, fantastic stuff. Thank you so much. Jess Menton, our senior equities reporter here at Bloomberg News, with an overview of what we can expect for the third quarter earnings season. And of course, we talked about the Mag 7. Let's zero in on the tech sector overall, because Netflix had its best day in a year, closing at a record high. And there's a slew of big tech results on deck. You've got Tesla, Apple, Meta, Alphabet, and Microsoft all set to report over the next few weeks. So joining us now to wrap it all together is Mark Douglas, President and CEO of Menton, which builds advertising software for brands. And given that a lot of these companies are essentially relying on advertising revenue, he's the perfect guy to speak with right now. Mark, thanks so much for joining us. I know Netflix reported, and we can put that aside, but I just wonder, when we look at Netflix and the kind of numbers that it posted and the fact that it's kind of in transition to a more advertising-driven business model, how much of it is really a media company versus a tech company at this point?
Well, right now, I think it's primarily media, but the advertising is going to kind of take it back to its roots, which is much more of an advertising company. I think what's not well understood is Netflix is adding, essentially ad-supported customers at a significantly faster rate than they're monetizing them. And that's creating a huge revenue backlog, similar to the password sharing backlog. And I think in 2 to 3 years, you're going to see that backlog turn into revenue. And I think they have the potential to become like the first $1 trillion stock in media. And so it's breathtaking in terms of the growth and their value stock at the same time.
As someone who runs an ad software company, how much visibility do advertisers have from Netflix? They're not disclosing things like the number of subscribers they have on their ad-supported tier, whereas Amazon, for the most part, that right off the bat, because it's the number of Prime subscribers, and they've moved everyone into the ad tier unless you upgrade out of the ad tier.
Yeah, I'm not sure advertisers really care that much. There's a transition occurring very rapidly from linear to streaming. And while that's occurring, essentially the streaming is becoming much more audience centric, meaning, who's watching the service, what kind of qualities they have. The advertisers are targeting those qualities and not just targeting the overall audience. And so I don't know any advertisers that are particularly, kind of concerned about the exact number of subscribers. I don't think it's an issue.
I am curious just about the mechanics when we talk about just how much advertising has proliferated beyond the more traditional areas. Obviously, Netflix has found a way to do this, or is trying to find a way to get its platform up and running. You obviously see a lot of potential for success there. But when we talk about Amazon's push into it, I'm talking like on its retail side, not necessarily on its streaming side, and other companies that have really started to experiment with this, social media companies that have really decided that, look, we've got a lot of eyeballs. How do we leverage them? Is there a sort of a critical mass, a point where you just reach a level where it's just too much, or is there enough opportunity out there, Mark, for everyone?
Well, I think there's a lot of opportunity, but the table stakes is you have to have an audience that cares about your content. And so if you're a media network and you don't have some specific reason like ESPN and sports or Netflix and comedy and documentaries and their other content to go and see them, you're going to suffer. If you have those, then like you're saying, then it's a matter of how well can we monetize that. Advertising is just a start of monetization. I think you're going to see, shopping directly off shows and things like that coming in the future. It's still a few years out, but the biggest streamers are going to or you're going to see them go beyond advertising itself. So it's it's kind of a big transition period we're in right now.
I'm going to ask you also, it's very much a layman's question, so don't jump it down my throat. But when we talk about building out these platforms, I mean, when you think of advertising in the old school sense, it was very cyclical. It had its ups and downs, and that created a lot of angst for investors, at least in publicly traded companies. How do these platforms today manage to smooth that out, to make sure that that advertising revenue and that business is a little bit more consistent on a month-to-month, year-to-year basis?
Yeah, I mean, it's really simple. You have to add more customers. Most of the big streaming networks with ad-supported platforms are essentially very dependent on just 1,000 large brands. And those brands don't generally increase their budgets at all, but they decrease them very quickly in any kind of economic downturn. So the way to counter that, I mean, it's essentially what Mountain does, is bring small and mid-sized advertisers into this market and really spread, essentially spread your revenue across not just the head of that tail, but across the long tail. And the companies that do that successfully, we're partnered with a lot of them. Mountain is, they're going to thrive, and the ones that don't, they're going to have problems, going forward. And so that's what's actually happening right now.
Mark, what are you thinking advertising revenue will look like for the likes of Alphabet, Meta, even Snap for the third quarter? The third quarter, of course, you have a period where there's a lot of people advertising with political campaign ads, and that, I know on the broadcast side, that tends to result in a lot of revenue. Does that translate into more revenue on the technology side?
Not really. I mean, like Mountain, we consider ourselves more on the tech side. We don't take political ads at all. I think that's for the most part true with most of the social platforms. So I don't think, and they also, it's a blip for them. I mean, Meta is over 100 billion in revenue, Google over 200 billion. So it's not a significant part of their revenue. The linear networks rely on it a lot more. Also, from talking to a lot of those political agencies, they're just very focused on kind of old school, linear local advertising, and they haven't adapted as quickly to digital targeted advertising as you would expect. Maybe the next election cycle they will.
The next election cycle. Give us a sense here, Mark, longer term here. I mean, we'll get past the election cycle, get into next year here. Are we going to see a little bit more of a shift in advertising, meaning is it possible we can see a sort of a new player bubble up in terms of grabbing those ad dollars away from the more traditional, or I should say at least the more dominant tech companies out there right now?
Yeah, I think the answer is yes. I think you will see a shift. What's going to happen is all of the streaming networks, and I talked to a lot of them, they are very, very focused. I mean, like the Disneys of the world and Peacocks and things like that, Warner Brothers, they are very focused on this like full shift from linear TV to streaming. And as part of that shift, I think they're becoming much more competitive with Google and Meta and TikTok. And so you're going to start to see them really take a bigger share of pie. They've always been very focused on what they charge, which is referred to as CPM. Now they're starting to get more focused on share of wallet, how much of the marketing goes to them, which is traditionally only Meta and Google very much focused on, but now I think all of the networks understand share of wallet is really important.
Mark Douglas, always a pleasure speaking with you. Mark is president and CEO of Mountain, which builds advertising software for brands. Coming up, we've got the top three. This is The Close. Time now for the top three, where we name drop the people driving some of the day's most talked about stories. And first up is Izzy Englander. His firm, Millennium, was looking to raise $10 billion of new capital for its hedge fund, Remain, but it's attracted double that amount.
Yeah, I mean, we've been talking about this latest fundraising that he's been going through over at Millennium, and they seem to be knocking it out of the park over and over again. Hema Palmer talked a lot about this here. And it gets to this idea that you can raise money in this environment. It's a harder environment to raise money. But if you have star power, and more importantly, like him, if you have a good track record, you can raise a lot of cash.
One down year since its founding in 1989, and that was in the year 2008. Of course.
Okay, there you go. All right, I'm keeping an eye on another very successful investor, Ray Dalio, of course, the founder of Bridgewater, and he's actually providing a bit of a warning around the U.S. election. Normally, I loathe these types of stories, but he's pretty adamant here. We're probably not going to find out who the winner of the U.S. presidential election and maybe even the congressional elections are on the night of it, on November 5th, as is traditional, and that we could see lawsuits and maybe even something a little bit more extreme, basically saying if you're an investor out there, prepare yourself.
Yeah, he actually narrowed it down to a 1 out of 3 every chance that the election outcome will be contested. And it's part of his larger thesis, of course, that the world is entering this period of greater risks, debt creation, internal conflicts, and these large power clashes between nations. All right, the third one is Elton John. The singer made a surprise appearance at Dua Lipa's concert to duet their song Cold Heart. Of course, he's no longer touring on his own, so him showing up at a concert at all was a huge surprise. He had his farewell tour last year. Yeah, I love this. So when I first read this story, they were describing this slinky red split-length dress with arm-length this, and then I realized they were actually talking about Dua Lipa and not Elton John. Although, if you saw what he wore, I mean, he was his normal flamboyant self. But it's always great to see it. I tell you, my Elton John, why I ran into him last Christmas. Into Elton John? Yeah, I guess he was performing somewhere in New York. On the street? No, yes, actually on the street. I think he was doing something like in front of Saks Fifth Avenue or something ridiculous. And I guess they were getting set. I mean, I just happened to kind of walk up. Maybe I went around a security gate I wasn't supposed to, and just saying. But anyway, I got to wave at him, and he just kind of, I can tell he had sunglasses on, so I don't know if he acknowledged me. That sounds about right. But I'm going to assume he acknowledged me. And a very flashy outfit, maybe a burgundy velvet suit. Oh, it was flashy. Something like that. All right, Elton John, of course, we love him, and good to see him back on the stage. When we return here, we're going to mark the anniversary of Black Monday, a look back at what is widely regarded as the first major financial crisis of the modern globalized era. That discussion coming up next on The Close, right here on Bloomberg. All right, for this day in history, we want to look back 37 years ago this week, tomorrow to be precise, October 19th, 1987, a.k.a. Black Monday. That was the day that the Dow and S&P each plunged more than 20% for what was then and still is now their worst percentage drop in history. An excruciating fall from grace that precipitated one of the first financial crises of the modern globalized era. The roots of that crisis began shortly after August 25th, the peak of a 44% 8-month rally in the Dow that had the average on pace for its best year since 1933. But a big part of that rally was due to a massive wave of M&A, a wave that was at risk of ebbing as Congress sought to pump the brakes on highly leveraged corporate takeovers. You combine that with concern around a slowing economy, a falling dollar, and benchmark Treasury yields at 10% and rising, and well, you combine that as well with other issues that appear to have also caused some issues. We talk about this idea here of that falling dollar, of those benchmark Treasury yields, and all of the other issues that tied into it. You throw in programmatic trading, antiquated guardrails at the NYSE, and the untested new trend of portfolio insurance. And you have a market that was ultra exposed to exogenous shocks. And they got one a few days later. The real drama began to unfold on Wednesday, October 14th, when the Dow plunged 4%. That was followed by a 2% slide Thursday, 5% drop on Friday. And then most market pundits thought it was all over, a modest correction, if you will. But on Saturday, October 17th, Treasury Secretary James Baker publicly threatened to devalue the U.S. dollar to curb a widening U.S. trade deficit, and it was the shot heard round the world in a big way. New Zealanders, they were first out of the gate, pushing their benchmark index down 60%, 6-0. The Hang Seng in Hong Kong was down 11. The DAX in Germany lost 8. And by the time U.S. markets opened on Monday morning, panic was in full swing. A GAO report released in January 1988 had an incredible anecdote of the day's actions, with market makers saying their phones were ringing off the hook all day long up until the final couple hours of the day, when one floor director said the phones, they just went silent. It was like everyone had just given up. 30 minutes after trading ended, John Phelan, the head of the NYSE, who had been warning all year long of a possible meltdown, he tried to calm investors, saying that the day's events was less panic and more of a reset after, quote, 5 years of a bull market without a correction. Eric Weiner, the author of a book called What Goes Up, The Uncensored History of Modern Wall Street, he chronicled what happened on Black Monday, saying Phelan the next day walked to the trading floor, reminding his floor directors of the importance of keeping the market functioning. That meant shutting down stocks with imbalances, putting up new bids and asks, and reopening them if needed. The future of the NYSE, he said, depended on it. While the market turned around on October 20th, rallying almost 6%, and then another 10% on October 21st, it would still take almost 2 years for the market to return to its pre-Black Monday levels. Scarlett? All right, well, we are happy to have Eric Weiner join us now. He is Bloomberg News senior editor and, as mentioned, author of What Goes Up. And the subhead on that book is The Uncensored History of Modern Wall Street, as told by the bankers, brokers, CEOs, and scoundrels who made it happen. Eric, great to see you.
Thank you for having me.
So where were you on October 19th? Because you were an adult and you remember this.
Oh, I remember it well. Actually, I was in college. I was 20 years old, and a friend of mine is Dan McCooey, whose family is floor brokers on the New York Stock Exchange. The McCooey Company was a well-known floor brokerage firm, and we didn't really have any awareness of what was going on, but he comes walking in during lunch and says, I may have to leave school. And we're saying, why? And he said, have you seen what's going on in the stock market? And we say, well, what does that have to do with anything? And he said, my dad's business may be going out. And so we took him out for drinks that night. And then the next day, he was like, oh, we're back in business. Yeah. But that was really the first time that I noticed that Wall Street and what was going on in the stock market had a direct impact on people's lives in ways that I just never really thought about.
And it was such an emotional roller coaster. I mean, there are so many stories about, grown men just literally crying, just off to the side crying, trying to figure out what's going on, how they're going to get their money back. The anecdote, though, that comes out of this is really in the days that followed. The idea that the Dow still ended the year higher in the green, only by a couple percentage points. And of course, within 18 months to 2 years, it had recouped all of those losses. So it was an incredibly painful day. But if you kept in invested and you rode that, you at least got back to break even.
The concept of buying the dip kind of originates with 1987. Obviously, it's more than a dip. Yeah. But the point is that things come back, and you have to realize that up until then, you had the 60s where the market had taken off, and then we went through the 70s, and all the way through even the early 80s, it was kind of dead. And people didn't really think of it as a place where you went to necessarily make money or anything like that. And then all of a sudden, it just takes off, whoosh. You have the M&A boom, you have all this other stuff going on, and everybody's paying attention. And then it crashes. And the thinking was, this is 29 again. Yeah. And instead, this is now the beginning of the modern market where things come back.
Yeah.
And the modern market also means that not only do you buy the dip, but you also look for the authorities to come in and help any way they can.
So there was no help. When you mentioned John Phelan, so Phelan and Jerry Corrigan, who was the head of the New York Fed at the time, got together and really made the point that they had to keep the market open, but they would shut down certain stocks. You have to realize there were no circuit breakers. Right. Yeah. There was nothing in the regulatory scheme that set up any of this stuff. So they ended up putting in guardrails. They ended up putting in places where you would halt and stop, and people can grab their breath. But that wasn't there.
But it wasn't there. But on the point of shutting things down, because that was intriguing to me. And several years ago, I interviewed Arthur Levitt, who went on to be SEC commissioner. Yep. He talked about how he got a phone call from Phelan saying they were ready to shut things down. And then somehow Phelan had a change of heart and they decided to keep things open. But then you had this huge disparity between what was going on in the cash market, what was going on futures. I think the CME did shut down for 30 minutes or so, right? And that just made things worse.
Things were not connected. That was also one of the first times, like you mentioned New Zealand. That was one of the first times where we saw, oh my God, this is a global thing. So we've got to coordinate. We can't just shut down one end of futures and have stocks trading. You had floor brokers, you had specialists going, shut this thing down. You had investors going, I need to get out. When they finally were able to take a step back, it was that point where they realized this is actually a trust game. And we have to get people to trust us. And the only way for that to happen is to not close the store when things get bad. As bad as it gets, we need to trade through this. And then actually they implored Greenspan, who was brand new at the time, to put out a statement saying that the Fed stood ready to back up whatever. And the point at that point, the idea is that the Fed is going to step in with some money, so we're not all going to perish.
And I like your point, though, about also keeping the store open, because we've seen this now repeated since then, of course, with 9/11. This idea that we need to reopen, and we need to reopen quick. It's a matter of trust, a matter of faith. We saw that again with the global financial crisis here.
Absolutely.
So again, it is really about leadership, and to a certain extent, those regulatory guardrails. Eric, great conversation. Got to leave it there. Eric Weiner, Bloomberg editor for us here in our studio, and he's the author of a great book. It was written a few years ago called What Goes Up. Definitely check it out. And you've written a couple other books, I think, too, as well here. All right, what are we doing?
We've got breaking news. Cigna and Humana remain. You pointed this out. Remember they were talking about a merger a while ago, and that never came to be?
Yeah.
They've revived efforts to combine. Cigna looking to combine with its smaller rival Humana after the talks fell apart late last year.
Yeah, I mean, those talks fell apart for a lot of reasons. Obviously, there was a price issue, but there was also that regulatory issue.
Absolutely.
And I mean, I don't know exactly what the impetus is behind restarting this here, but of course, the big question is this a deal that can get done?
Well, maybe. We'll have to see what happens in January.
Yeah.
But the thinking is that, now we can at least start this conversation. And it also comes on the heels of some pretty disappointing results from CVS, pre-announced results. All right. By the way, let's just give you a quick recap of what happened on the day. It was just another record high on a Friday. This tends to happen. It's happened, 46 or 47 times this year, a record high for the S&P 500?
Alex is the timekeeper on that. Unfortunately, she's out today.
40
but
plus,
yes,
right?
40 plus, yeah. We're approaching 50.
Let's get to, after Netflix's big earnings beat, big tech in focus. Tesla will kick off earnings for the Mag 7 next week. Not much movement on the treasuries and yields, even though there was a big repricing yesterday.
Yeah. All right, we'll be back in a moment. This is Bloomberg. All right, it's time now for our next sub-segment where we highlight the entrepreneurs and trendsetters really moving up in the world. And today we are going to focus in on making lemonade out of lemons. We're going to talk to an entrepreneur who has done just that. After 2 bee stings, she was inspired to create her own honey-sweetened lemonade company when she was just 4 years old. 15 years later, and that business is still going strong. Her name is Mikaila Ulmer. She's the founder and CEO of Me and the Bees Lemonade, and I'm pleased to say that she joins us right here. I chuckled a little bit because I see a 15-year-old company and I'm talking to someone who's in their 20s. That's impressive, to say the least. I do want to talk about that evolution, Mikaila. I mean, you are now an adult, a woman, and you now have a company that has done very well. And I am curious as to what your mindset is now as to what you either wanted to do with Me and the Bees, or maybe do you want to do something else? Like, where does this take you next?
It's a fantastic question. And going back to your initial point, it is crazy. It's very wild to be able to say that I've been in 15 years of business and I have 15 years of experience as a 20-year-old. That's definitely something that's a little bit out of the ordinary. But as for Me and the Bees, I'm continuing to scale the company. So I still want to see increased distribution throughout the United States, potentially internationally. I'd like to see new beverage lines, new beverage flavors. But me personally, I'm planning on applying the years of experience growing and scaling Me and the Bees to investing in other companies. So as an economics major and a quantitative sciences and statistical sciences major at Emory University, I'm currently deciding, exactly what career path is the best way to do that. But overall, it's working on our mission to save the bees through Me and the Bees, and it's learning as much as I can about how I can see that growth potential in other companies and value in other companies.
I'm in awe of you, Mikaila. Just everything that you said there, and you're also a full-time student, at university. I'm curious whether lemonade is always going to be part of your brand. I know you mentioned the bees and honey and how that is part of the mission. What have you observed about consumer tastes in the college setting that you may incorporate into your product line? For instance, caffeinated beverages, or I don't know, maybe alcoholic or cannabis infused drinks. I'm just curious to see where you might take it.
Well, I think one thing that we're noticing with Gen Z is that we are shifting from all alcoholic to some non-alcoholic. And so what Me and the Bees is doing is we're making sure to hit on the non-alcoholic, ready to go, fun and functional beverage industry. And we're noticing that across the board, beverages are shifting to delivering the most that they can in however many ounces that they can to their customers. And as a member of Gen Z myself, I see that among people my age, but I also get to apply that with my company, Me and the Bees, and the flavors that we offer. So since the very beginning, I started after getting stung by 2 bees in 1 week. I learned about the impact of bees on our food system, and I made honey sweetened lemonade. But we've kept the entire mission of having a honey sweetened lemonade that's inspired by my great Granny Helen's 1940s cookbook, but adding fun and functional flavors. So we started with mint, and then we added ginger and prickly pear and black cherry and passion fruit, our most recent additions. But overall, making sure that we're delivering a great tasting beverage, a beverage with a good mission, and a beverage that offers something to our customers as they're on the go. And Gen Z is loving it. Yeah. And that's what Gen Z is looking for in their
You talk about building a business with the mission, and it's kind of interesting too. And maybe you could kind of give some advice if there are some young folks out there who, are looking to start a business here. It's not just about the business itself. You really do have to find a way to connect with people in a way that they can sort of, digest. And you seem to do that. And maybe that's because you are young and cute. But even if you're not that, you can still do that, right?
Yes, I think whether you're large or small, any company can add a social mission or some sort of environmental ambition to their company. And especially if you're trying to capture Gen Z, that's what we're looking for. We're not only looking for the good in service, we're looking for a company that does good. We're looking for a brand that we can get behind. And that's my advice to companies and C-suite executives, but also people who are starting their companies or people like me who are young and who want to start their company. Figure out not only how you can solve a problem through the good and service that you're providing, but also what kind of social environmental impact can you make?
We only have about 30 seconds left, Mikaila, but how are the bees doing? I mean, we hear so much about this issue and how it's really going to have a huge impact on our food supply if we don't get it right.
We are hearing a lot. And one thing I'm excited to announce is that bee populations have bounced back. So there's about 3.8 million hives nationwide. And since Me and the Bee started back in 2009, the shift has changed from saving honeybees to now saving wild and native bees, and then also protecting bees from different factors such as more harsh weather conditions as we're seeing today. But I'm happy to say that we've made a measurable impact. We've contributed over $360,000 to our mission to save the bees. And now that mission has expanded, I get to act through my nonprofit, the Healthy Hive Foundation, and through my book, Be Fearless, and through my work here at Me and the Bees. Towards that mission. All
right. Well, we're all really impressed here by just how far this has come from a lemonade stand to a bona fide business and the nonprofit. We have to leave it there. Mikaila, great to talk to you. Mikaila Ulmer, founder and CEO of Me and the Bees Lemonade. Stick with us. We'll be back in a moment. This is Bloomberg.
The presidential race entering its final push, and both candidates are covering the airwaves. Trump is seeking to get ahead in PA as Harris and her fellow Democrats are focusing their attention on battleground states like Georgia and Michigan. So here now to discuss the current state of the race is Kim Wallace. He is 22V Research's Senior Managing Director and Head of Washington Policy Research. Kim, elections are all about momentum. Who or what has the momentum right now?
That's undiscernible right now, Scarlett. There are several ways to measure that. And if you stack them all together, I would say you'd have to put a thumb on the scale to say one has more momentum than the other. They are contrasting styles in the way they're approaching the last few weeks of the campaign. Former President Trump is relying on a very top-down strategy to elevate his national profile. And the Vice President Harris, continues a state-by-state bottom-up push that she and her camp believe will show fruit.
I am curious, Kim. I get asked a lot of questions about some of the election betting sites out there and sort of whether we should be paying attention to that as some sort of true barometer of maybe where this this election might go. Forgive me. And I'm curious, is there any credence or do you find any value in looking at some of that data coming out of those betting sites?
Romaine, I do not, and I'm not alone. Most people who analyze policy risk or look at elections don't pay much attention to betting sites for a few reasons. They generally are a very narrow slice of the U.S. demographic, an even thinner slice of the U.S. electorate. It's hard to validate or know how many of the people participating on the sites actually vote or have voted in the past or are registered to vote. The track record of the betting sites the last 3 or 4 national elections hasn't been that good, and they are open to either manipulation or sway, influence, depending on your view. So, no, I don't know many people who pay attention to them in a serious way.
Okay, so if you're not paying attention to the betting sites, how much do you pay attention to the polls? How much do you trust the polls? Because they've been wrong in 2016. They were not necessarily accurate in 2020 either. Have they gotten it right this time around?
Pollsters will tell you they improved the science part. What they cannot control, I believe, is call it the 1/10 of the subjective part, and that is the modeling assumptions, Scarlett. They would like us to believe that they know exactly how to find rural voters that support Trump in Wisconsin and young women in Nevada who support Harris. But we'll find out retrospectively. There's always a human element in these polls in terms of the surveys, how they're constructed and how they're scored. So, no, I don't find them to be terribly important, especially in the final days. We watch trends. We've watched them for the last 6 quarters, and those trends tell you generally the vice president is ahead nationally 2.5 to 3 points, and that the 8 to 10 important states in the Senate and overall for the Electoral College are close and tighter than they were 6 weeks ago. I don't know that you can discern much more from that.
I am curious, though. I mean, with 2.5 weeks to go, roughly, Kim, and with early voting already started in certain areas, is there a way for either of the candidates to really sway a meaningful number of voters in these last 2 weeks or so?
Sure. If they have done their homework and their teams are very good in the science of where they target the outreach, which counties of states, we're not talking about entire states now, we're talking counties and in some cases precincts. Absolutely, you can build a strategy. It takes a lot of time, some investment, and commitment from the candidates. But yes, they can get good at this in the last couple of days in terms of juicing the turnout. It's also important, less so surrogates, although they may help at the top level. It's much more important to be close to mayors and governors who are used to turning out votes in every 2-year cycles.
All right, Kim, have to leave it there. I'm sure we're going to talk again soon over the next couple of weeks. Kim Wallace, Senior Managing Director over at 22B Research, as we now push ahead to what the market will have their eye on over the next week. And we start off on Monday with the World Bank and IMF meetings getting underway in Washington.
There's also the leading economic indicators index, but really the earnings season gets underway on Tuesday. You've got a lot of earnings before the bell, notably General Motors, Lockheed Martin, from a big cross-section of the economy, Texas Instruments in the afternoon as well. Yeah, you get a cross-section of the economy there. Here, you're also getting some economic data out of the Richmond Fed on the manufacturing side as well as on the sentiment side as well. We push ahead to Wednesday here, existing home sales and mortgage apps. Those are your 2 main economic data points, but I think it's earnings that are really going to be in the spotlight. Yeah, starting AT&T, Boeing, Coca-Cola, Hilton, T-Mobile, and then in the afternoon, we'll be breaking Tesla's earnings as well. Yeah, I'm trying to look at these, and you're trying to divine sort of what's going to be the real barometer. I mean, obviously not Tesla, obviously not Boeing. These are very idiosyncratic stories. But I do think we could see here something interesting out of Coca-Cola and even potentially out of Hilton as well. Let's keep it going here with Thursday here. On the economic front, you get jobless claims as well as S&P Global PMIs, new home sales, and yet another long slate of important earnings. And what I'm paying attention to here is UPS, given that a lot of people are no longer paying up for premium shipping, expedited shipping, and companies like UPS and FedEx are definitely feeling that. I never knew who those people were because I'm always like, whenever I go into there, they're like, which option do you want? I was like, the cheapest one. Absolutely. But you're a planner. I know you buy your holiday gifts like months in advance. I do. I've actually already started Scarlet Fu. And by the way, hint, hint, I didn't get anything from you last year. All right, and let's keep it going. Friday, we get durable goods, a UMich sentiment, more earnings out of Colgate-Palmolive. And you're a sports fan. Look at that. World Series. The World Series. Who you got? Subway Series all the way. All right, full coverage coming up next week right here on The Close. All your politics coverage coming up next on Balance of Power. This is Bloomberg.